Vamos a hablar con Bertrand Cliquet, gestor value de Lazar Asset Management. Bertrand, good morning.
Good morning, buenos días.
Buenos días. You describe yourself as a value investor. Do all good and low prices companies work for the fund?
Yes, I think, I need to clarify a little bit, because for us, value investing is not about silos or classification by an index provider. It's really trying to find companies that are inexpensive compared to their intrinsic value. So it really requires a lot of in-depth fundamental analysis of companies and share prices to identify those valuation gaps we're after.
What do you consider an economic franchise?
Yeah, so economic franchise is essentially trying to help us find very high quality businesses that will earn very high return on capital or regulated returns on capital, which will reduce the risk of forecasting their future cash flows and earnings. So to give you some example, it can be natural monopoly, like in Spain, you have Red Eléctrica, one company doing high voltage transmission of electricity, so it's regulated by the government. It can be a company that has size. So if you think AB InBev, the largest producer of beer in the world, is so much bigger than the next competitor that it has very, very high return on capital, uses the scale. It can be a network effect. So if you think about Alphabet, Google has this type of network effect, or Visa, for example. It can be companies that have brands or intellectual property. So some luxury companies, wonder why we're paying so much for some of these luxury goods. It's very much the brand and the value we attach to this brand. And the last one is switching cost, when it's very, very difficult to change an organization that would have Oracle, for example. And so these economic franchises will give us the ability to have a greater certainty on future earnings. And if we have that, then we can be much more assertive on intrinsic value and narrow down what we think is the fair value of those businesses.
How do you identify the economic franchise games that go into your portfolio?
Yes, I think the first step is finding a universe of very high quality companies that are those franchise companies. So it's only about 220 companies globally. So it's a very, very selective club. And then we'd say, okay, we are happy with the companies from a risk standpoint and cash flow profile, but hang on, valuation is essential to the success of an investor. So what we do as a member of the team, we do a lot of very in-depth analysis, financial modeling, forecasting. We apply a very strict valuation methodology on our companies, and we simply rank companies in order of upside. So if you think about the most attractively valued companies, it will be a high gap between the share price and the intrinsic value. And on the other end of the spectrum, some companies will be expensive. So what we simply do is focus the portfolio on the top 25 and 50 names that are inexpensively valued, and we leave these excellent companies but that are expensive on the side for another time when hopefully they will become inexpensive.
Mm-hmm. With earnings seasons approaching, is it time for value investing?
Well, it's a very good question. I think for us, our process requires us to be really long-term, giving an investment case time to come to fruition, so 3 to 5 years. And most earnings releases, they don't tell you a lot about the fundamental change to a company. But what they give us sometimes is, because the market is so short and focused, there will be overreaction. And this overreaction provides opportunities for us.
And what do you expect for the coming months based on inflation perspective?
Yes, I think it remains quite a challenging market environment in our view for several reasons. The first one is valuations are not cheap. I think we can identify, and that's the good news, today 26 companies that we think will achieve more than 10% return for our investors going forward. So we have a high confidence in our portfolio, but it's not a broad-based, we're not in March 2009, let's put it this way. It's not a broad-based valuation opportunity. And there are two things you rightly pointed out that remain challenging. The first one is the market, in our view, hasn't adjusted to the new macroeconomic environment when it comes to inflation. Inflation will hurt companies' earnings, because not everyone will be able to increase prices constantly. That's the first one. And second, the new monetary policies. Higher interest rates are more likely to be here to stay. It will create some challenges for companies and has really direct implication for how we or the market should value stocks.
Why is Japan now attractive?
Yes, I think what we find attractive is, as I said, about 26 companies. But if we take a number of examples, but let's just take one. Secom is a Japanese security business. It has very, very high market share. So what it does is, security for homes, and companies, and you tend to have contracts that are renewed on a quite frequent basis. And as a source of economic franchise, it is one that has scale, and they've really put that to use. And then the valuation opportunity really is interesting in our view, and we are starting to see companies doing some gestures towards better managing its business and being a bit more astute in terms of capital deployment, which we think will be rewarded.
So thank you for this time. Bertrand Cliquet, gestor value de Lazar Asset Management. Thank you. Good day and good business.
Goodbye.
Bye.